All right, welcome back. Let's talk about money. Because while they say the rich are just like the rest of us, it's not exactly true, at least when it comes to investing. How do we know that? Well, because we get to talk to them and we get to ask them and find out what kind of investments they love right now. And one big group we love to talk to is Tiger 21, which calls itself an ultra high net worth peer advisory network. But in reality, it's just a great group of people who have become very successful in life. I go and speak at their annual conference. We're joined now by Michael Sonnenfeldt. He is the founder and chair of Tiger 21. By the way, made his fortune by working on the docks of Jersey City, going to some dump called MIT. Apparently, you know about that?
I've heard of it.
You've heard about her husband went there as well. Coming back, buying those docks and developing the harbor side. At that point, I think the best real estate deal in the history of New York.
Certainly one of them. We did well. It was great.
You've done well, and now you launched Tiger 21. So you guys come out with these asset allocation reports. What I'm always shocked by, and I probably shouldn't say this on this network, is that stocks, your teams love them, but they like them. They don't love them, right? They're still not the highest. They love real estate.
We love real estate, private particularly, and private equity. Both are at 28%. So 56% in the private markets, 24% in public equity, and a lot of it in ETFs and indexes. So stock picking is sort of fourth on the list.
Well, is that because you're a real estate guy? Like, do you just is this your cabal of if you know real estate, and a lot of us don't.
Yeah.
And so we're afraid to even approach it from an investing point of view. Like, I look at it and I'm like, what's available to me where I'm going to have some kind of edge?
So if you made your money in real estate, you're going to want to invest in real estate even after you cash out from your company. If you made your money in private equity, you want to be able to roll up your shirt sleeve, be on a board. You want to be involved. You don't want to, as a shareholder, you're the last to know of a problem. As a private equity direct owner or investor, sometimes they call you when they have a problem and ask you how to fix it. So our members have a bias because of their unusual skills. Our members are 1 in 10,000 by accomplishment. It's like Major League football, baseball, basketball. This is the major leagues of entrepreneurs around the globe. 1,600 members, $200 billion in assets.
So when they are interested in real estate investing, I mean, that's such a broad thing to do. You can own apartments directly, or you can be in a REIT, or you can be in, I'm sure, many of these private vehicles that maybe they have access to that people wouldn't. What kind of real estate investing?
So obviously there's all these sectors, office, but residential would be the largest. Direct ownership, garden apartments across the country, multifamily, high-rise, a lot of retail. In the last 5 years, industrial has been screaming, coming back a little now. But you'd have to say industrial's been the strongest and multifamily the most constant. Biggest flux is retail and office.
And one of the benefits of Tiger is that they will often like trade ideas. They'll say, well, I've got this investment here. Do you want in?
Yeah.
And I've seen commercial real estate. I'm not any of these, by the way. Don't have the money and not invited. But they're investing in these sort of retail developments with Whole Foods and anchor tenants and good returns. So does it come down, Michael, to more of a knowledge thing and a control
Next Tuesday, we have members flying in from all over the country to look at a members mall in the South. It's a multi-$100 million mall, and he can call on a network of members that are now flying in to spend a day to help him strategize what the best execution is. Do I develop the mall? Do I sell it? What are my options? How can I do it?
When's the last time that real estate had a real down cycle? You know, when I think about it, because it makes a certain amount of sense that, I hate to use the term dollar debasement again, but here we go. You know, when there's a fixed amount of physical space in the country, and when you're developing these properties and whatever, it's almost always a bull market, it seems. Now, we know there's pockets where there's pullback, there's the SNL crisis and things like that, but how do they navigate face down markets?
And this is one of the things that's so important. In the late 80s, the real estate markets froze up. That was the SNL crisis. If you're not in business 40 years, you don't believe markets can freeze up. So you invest. That's the problem with not having experience. You just don't believe it'll happen. But I lived through it. I saw the markets freeze up. It's an example today in the venture capital area. It's freezing up a little. It's not the same. It's not stopped. But if you're in the venture capital business today, it means you're investing in a company that doesn't have revenue or cash flow or profits. that means you're going to need to raise capital in the next 12 to 24 months. Will the markets be functioning better than they're functioning today or not at all? Because you're not just making a bet on the company. You're making a bet on the markets 12 to 24
I know
months.
we got to go. This is critical. You worked at Goldman Sachs out of MIT.
Yeah.
And so forget about Tiger for a second. I think the point you're making is very critical because people make fun of age. Let's be honest.
Yeah.
Like, oh, old man, okay, boomer. Here's the reality. If you're under 45 years old, you've probably never managed money in a really bad market on Wall Street. And that's the bare minimum.
Yeah.
Right?
Yeah.
There is a value to age and experience that you can't replicate. You can't read in a book.
There's also a reason why fighter pilots, firemen, grain operators are 28 years old, because at 28 years old, the male on average will take risks that others are afraid of. So having the combination of wisdom, experience, tempering that ambition that peaks at a 28-year-old is really the magic combination.
Is it ultimately come down then, when you've been through these cycles, to saying, well, I know what projects not to say yes to, or I have enough of a buffer that I can kind of hang on and ride this out when liquidity freezes up?
So our whole our meetings take place. What's an all-weather portfolio? How do I have a portfolio? Right now, our members are very long, 80% between public-private and public equity, private equity, and real estate. But we also have 10% cash. So how do you balance almost no debt? So having an all-weather portfolio that can do well in a good time, but not too badly in a bad time, that's easily said, but hard to execute. That's what our members are learning from one another and really honing as a skill.
I feel like we've got a little bit of a window into it. If you're interested, check out Tiger 21. But Michael, really appreciate you coming on, doing the allocation survey. Thank you very much.
Thank you.